In this video, a huge report from Coinbase Institutional, their 2024 outlook. We're going to go through this report, the key themes here, where they see some investment flows coming through this cycle. I'll leave timestamps below for all of the different sections and themes in this video. So it's going to be a long one, so we'll get right into it. Key themes for 2024. What are we looking at? Through this part, this is like an intro, and then they get more specific with some of the themes later. They're really looking at Bitcoin and then which network is going to get all of the activity. And it's basically Ethereum. Now, no surprises there because Coinbase has, put its flag in the ground with Ethereum. It's building on Ethereum, and Bitcoin, of course, is Bitcoin. And so Bitcoin is not crypto. It's different, and it's going to lead things initially with the halving. And then after that, maybe some other themes will, start to mature a little bit. So let's see what they think. Although there may be some capital rotation into riskier parts of the asset class, next year, we still believe institutional flows will remain firmly anchored on Bitcoin, at least through the first half of 2024. I've written same as always here. As you know, the Bitcoin cycle every 4 years, Bitcoin usually leads in terms of its price gains and its activity. And then throughout the mid and late cycle, you get some of that wealth creation flowing into riskier parts of the asset class as people just feel wealthier or they feel more confident. It's very, very normal. This is what we're looking at with crypto. So the red line is crypto, long-term secular growth. Very, very obvious at this point. The green is the short-term price cycles manipulated by central banks around the world when they raise or lower interest rates, push money in, take money out. So they manipulate prices short-term, and we're going into an inflection, right? So we've had the bottom, now we're coming kind of out of it at this point. So we're going into a price cycle expansion, which is great news. But also bad news if you're looking to invest because you obviously want lower prices. We know crypto's going up and to the right long term. So that's where we are. We're in this kind of potential expansion out of the drawdown in prices, but crypto is growing a lot. So where's it growing? Coinbase think it's growing on ETH, but there are some other opportunities according to them. The trading regime for crypto may pivot towards Web3 apps as market players focus on more use cases. What they're looking at is Coinbase VC, right? They're big venture capital investors, one of the biggest in the space. They've got unlimited funds. They can raise money in public. They can raise money. They can invest in hundreds and thousands of these apps. We can't do that, right? We don't have the capital. We don't have the resources to do that. We have to be much more specific and pick out just some broad exposure to the asset. That's what we can do as kind of retail investors, right? Like Bitcoin, ETH, some other layer ones that you think are going to be decent. That's kind of it. Maybe some speculative bets on the side with a small percentage of the portfolio. There's not really much else we can do. We can't play the VC games and invest in applications because we're not in at the seed stage. We're not getting that really cheap seed stage equity and other things. And so we're buying public market assets. By the time an asset is public and brought to market, it's already way more expensive than the VCs got in at. So we can't play VC games. We can't buy all of this public stuff. We have to be much more specific, I think, to get our exposure. As you can see here, in early 2004, there were at least 6 other social media platforms, but Facebook won out in the end. Given the nascency of the digital asset class, we expect many market participants to rely more on proxies and platform plays. I think they're looking at Coin, right? Coin, they're pumping their own equity here, right? Because what they're saying is, hey, you want to invest in crypto? We're doing everything in crypto. Just invest in us and you can get exposure to it. That's what they're saying. For us, maybe yes, Coin, but also Bitcoin, ETH, layer ones. That's the exposure because loads of stuff's happening on top. We can't, we don't know what exactly is going to work out, but the layer ones are going to be there if it does. So that's your exposure, right? As a retail investor. Now, as you can see here, what they're saying is they really are focusing on Ethereum in terms of its dominance. And like I said, Coinbase is Ethereum. They're building on Ethereum. So let's see what they think of this. Market players increasingly focus on applications. We expect more alt L1s to repurpose their networks in a way that better aligns with the shifting narrative. What they're saying is not everything can be an L1. Ethereum is the L1. That kind of won that race. It's secure. It does its job well. It's a large institutional settlement layer. If you want a game, if you want an application, then you're better off building an L2 on top of ETH because you can reduce fees and you can be more specific. So there's no, like, the L1 thing is kind of done. Like, we don't need any more L1s, right? There aren't going to be any more large scale L1s. All of the money's not going to there. That market is saturated. So what funds are doing now is focusing on applications. So what's happening as the industry matures is you're getting a move up the value chain of where money flows in. You can't compete with ETH or a couple of the other L1s that are now very, very dominant. So if you want money, if you want to raise money from a VC, it's about applications, getting end users, right? And actually building out the business side of things. So that's what Coinbase is saying right here. So this is Ethereum in gray. And what you can see is that activity is not significantly lower, right? Even throughout the bear market, it's pretty much the same. What does that tell me? That tells me that there is a base of broad institutional demand on that settlement layer. Ethereum is expensive. You and me, retail users, don't really like it because we don't want to pay the fees. Institutions don't care about paying $5, $7, or even $50 when they're trading or sending around 50 million bucks. So that institutional demand is there. Now, retail, they're going to get priced out of Ethereum because Ethereum is institutional settlement. Retail investors are going towards L2s, right? Arbitrum, Optimism, Base, you can see that here. These are more centralized, right? There's more trust assumptions here, but retail investors don't care about that. We want cheap fees, right? We want to send money for free. We want to do things for a small fee. We're fine with that. So we're getting priced out of the institutional settlement layer, and we are being pushed out to the edges to the cheaper layers. And we're fine with that because we can take the centralization and everything else. That's what's happening with Solana as well. On social media and everything, you're seeing a lot of people saying, Ethereum, that's dead. I'm moving to Solana because it's cheaper. So let's just get Siri out of the way. I'm moving to Solana because it's cheaper and it's better for me. Yeah, that's great. You're just one type of user though, right? Because institutions, they don't care about cheap. They want large scale institutional settlement, liquidity. That's the thing they focus on. Paying $50 for that is absolutely fine. So institutions are using Ethereum, retail is getting pushed out to either layer 2s or maybe Solana or some other cheaper networks. Another use case here and something that Coinbase are potentially looking at is gaming. Crypto gaming is very hot as a topic. I think the way that you monetize games with crypto that can also benefit a token specifically is very, very spurious, to be honest. I don't see a lot of the mix up here. Now, if we're going into a bull market, narratives win out. Fundamental value is basically irrelevant. You just need to get into hot topics and narratives and buy them early. And then that's great. That's trading. That's tactical if you want to do that. But if you don't, and you're a long-term investor, a lot of this stuff is nowhere near actually being anywhere investable. So for what Coinbase say, for example, gaming studios have considered minting Web3 primitives like NFTs that can be used, transferred, or sold in game, or on designated marketplaces. However, surveys indicate that a large majority of gamers dislike NFTs. How do you use crypto to make a game better? In-game items, NFTs, yeah, I get it. Why does that benefit the game developer? Well, maybe the users trade those NFTs and pay a trading fee. Okay, I get that. So that makes an income stream for the business. So you have a game developer running a business, running some sort of marketplace on their game. Is that going to get regulated? Do they need to become a registered agent in the States in terms of securities agents? Because do they need that, right? How are they going to make money? It's all very muddy, right? How do they actually make money from the crypto aspect? Trading of NFTs. Okay, but there's like 100 NFT platforms. None of them really make much money. They're trying to give away tokens to incentivize use. Right, the business use case is so little right now, but there's this big narrative of crypto gaming. Gaming's a huge industry. Yeah, I get it. How are you earning money through the crypto aspect? If you're charging a blockchain fee, why would gamers want to pay a blockchain fee to play a game? It's just so you have to abstract away the blockchain fee. So that means that the blockchain network that it's on, the coin doesn't earn any money, right? So that's weird as well. So it's a completely uninvestable thing in my opinion. So why do we need a blockchain for a game? We need a blockchain for the assets of the game. So that's Ethereum or some other L2. So I get that. You need a blockchain for the assets of the game. And so you're expecting users to pay to do something with those, either hold them or trade them. And then that game is essentially now just a crypto exchange, right? So it just doesn't, where, like, how does that benefit a singular token? Are you a crypto exchange? How much money are you making? So none of that actually is relevant for the bull market if you're just trading these coins, but the actual business use case with crypto is not really there right now. So yes, we need digital money so that we can use it within games, but it's just a game. And unless you have an equitable ownership of the profits of that game, what are you actually invested in? If you're invested in NFTs or some weird token that's like used to incentivize stuff, it's not really an investment. But like I said, in bull markets, it's just going to go, obviously gaming is going to be a big narrative. The best Web3 game right now is meme coins. So people are looking, I think, just to the Web 2 version of things, being like, invent a game with graphics and this and that. But actually in crypto, the best game is using actual money, PvP style, trading against other people around the world in real time for these stupid meme coins. That's like a real life game of gambling that people are playing right now. And so that's where the money is, right? So what you're saying is like a kind of old school type game, how to integrate that. I think integrating old school type games into cryptos, the use case is, it's there, but not really mature yet. The game that everyone plays now is trading coins in the real world with real money. And that's where they get their fix. There's also some other themes about how to decentralize infrastructure here. They say DePIN, which is decentralized physical infrastructure network, I think, and Decomp, decentralized compute. So again, both DePIN and Decomp utilize token incentives to drive resource creation and consumption for real-world constructs. In the case of DePIN, this is projects depending on creating economic models that help incentivize participants to build physical infrastructure. So an example of this is Helium on Solana, where what they're doing is paying you tokens to buy a 4G or 5G signal and put it in your house. So you create this Wi-Fi or this 5G network, you buy the thing, you put it in your house, and then whenever someone uses that part of the network, you get paid some of like the fee of the network fees that these people pay. I think this is also just kind of nonsense as well, right? Because this is not how business works. Business works by having a real centralized business entity that focuses specifically on one thing and becoming very good at that one thing, driving costs down through economies of scale, right? And then selling it at a price that other people couldn't manufacture it at. The way of using blockchain to kind of try and make this decentralized is, well, firstly, it hasn't worked yet. Maybe at a small scale, but at a big scale, it's never worked before in industry generally. So why would it work now? You can see they also say that there's a big downside here. The drawbacks include high initial outlays, technical complexity, quality control, economies of scale, to name a few. Many DePIN projects have focused on how to incentivize participants. Ponzi-nomics, pay to play, right? We're going to pay you tokens to walk around, right? Cannot work, right? It's an unsustainable business. But only a few have started to tackle the financialization models for driving demand. Again, this is a narrative that may pop off in the bull market, but something that really just hasn't got any real fundamental kind of profits or users or anything like that. So, buy some stuff, we'll give you some tokens to do that thing, but then there's no users here because the networks aren't at scale. And so how do you get that business running? I think it's a narrative, but something that I wouldn't want to be anywhere near. These types of narratives are really people trying to make money off of a business idea and getting a token out there, getting the valuation, selling some of the token for money. So the business model is actually, here's a wacky idea, we're going to sell the token. As long as this token's out in the market, then we've made our money anyway, right? And so again, like I said, playing VC for us isn't really where we want to be. The invention of blockchain is send money from one person to another. But if you're a decentralized infrastructure network, why do you need a token? Why don't you just use the money that was invented? Well, the reason is because they probably know that their business isn't going to work out. And so their business model to make money is they need their own token so they can sell it for money. So let's not get caught up in that. In a bull market, things go up because of narrative, but investing in, real long-term secular plays is where the real money's made over, multiple cycles. Let's get into Bitcoin. I'm going to be updating the Crypto Investor course in January. The price is going to go up. If you're in it already, everything is free for you. You might want to look at the link below before January. It's going to be, I think, around 15 videos on, my strategy here with the Bitcoin halving, bull market coming up. So 15 new videos are coming. If you've got the course already, they'll be coming for free for you in January. If you're new, then the price is going to go up in January, but you can have a look now. So we're going to look at Bitcoin. What's happening here? Bitcoin strength in 2024 should be well supported by themes like spot ETFs, the halving, and a fall in real rates. In our view, the halving's underlying significance lies in its ability to raise media attention around what makes Bitcoin unique. A fixed deflationary supply schedule, disinflationary, that culminates in a maximum supply limit of 21 million Bitcoin. This point often goes underappreciated. For physical commodities, additional resources can theoretically be applied to mine and extract more gold or copper, for example. Bitcoin is not a commodity. It's regulated as such in the States, kind of, because there's no way other to regulate it. You have to call it a commodity, but Bitcoin isn't a commodity, it's a scarcity. And the digital network was created to do one thing and one thing only, which was just run that network as a non-government money where you can send Bitcoin from one person to another. That's it. That's all it does. But it's very simple, but very important. What you're doing with Bitcoin is just saying fiat currency debases over time. So that goes down in value versus things that are scarce and desirable. Bitcoin is scarce and desirable for many different reasons. It's digital capital, can move it around fast. You can buy and sell small amounts of it. It's fungible. So that's it with BTC. So I think we all know that now. The reason why, not as many people are really interested in Bitcoin is because they don't see the economic, the way that they can really make fast gains with it. You're not supposed to make fast gains with BTC. It's supposed to be the kind of cornerstone of your long-term investment plan. Everyone's looking for the narratives in a bull market. Bitcoin does its thing. It's going to go up if the dollar is debased or weakened, and that's about it. So again, pretty reliable. Everyone knows that at this point, which is why institutions are getting in. And of course, over time, percentage gains are going to get crushed down. And that's why people will always look for other opportunities, in different areas of the market. We believe usage catalysts will originate from technological innovation, mostly within the confines of the existing network protocol. What they mean here is they don't see anything really happening with Bitcoin. Like there's no layer 2s that are really popping off. There's some little things here, but they're not really very popular. No one uses them. They're not big. There's not a lot of capital flowing in there. All of the business stuff is out from Coinbase and Binance on Ethereum and their own blockchains. But what they're looking at is ordinals. So ordinals, kind of NFT type things on Bitcoin. Not exactly the same, but you can inscribe, bits of data on the blockchain. So again, ordinals are out. So that's the risky end. And of course, the network. If you just want exposure generally, then you're just buying the network underlying. Technical progress on the Lightning Network, perhaps the most well-known Bitcoin scaling solution, has continued this year. Again, Lightning Network is great. It's kind of small scale, kind of works a little bit. It's good for the people that use it, but the masses aren't demanding Lightning, right? So especially in the West, people aren't demanding Lightning, right? If you want to send a payment, you can, send a bank transfer or something. It kind of works for you, right? So really the big thing is, how can I protect my savings against currency debasement over 10, 15, 20 years? That's the real thing if you're in the West. Now, if you're in other parts of the world, maybe the Lightning Network is going to be really important for you, but you're also using Tron, you're also using dollars on other networks, because that's actually what you want, because that's a store of value for you getting paid, right? Because maybe your savings, you don't have any savings or very, very small, so you're not looking at Bitcoin. You certainly can't use the Bitcoin network because that's too expensive. So these are good. These are much slower. Not really like it's not like Lightning Network is just going to suddenly change everything, but Bitcoin is just continuing its slow, steady march over time. And then we get to Ethereum. Ethereum has underperformed Bitcoin recently. That's totally normal. Same as always, like I've written here, Ethereum usually underperforms Bitcoin at this stage in the macro cycle and the Bitcoin cycle. This is Bitcoin's time. If it can't outperform now, it's in trouble, right? So this is Bitcoin's time to outperform. The passive flows and the kind of marginal dollar is going into Bitcoin a bit more. And Ethereum is very large at this point, right? It's already $200 billion in size. It's not like it was last cycle where it's still pretty small. You had big percentage gains. Ethereum is now going to be slower, more reliable, and therefore, like I said, percentage gains get crushed. Still big in the big scheme of things, like bigger than most equities and indexes, but it's not going to get, you know, the crazy gains like it did last cycle because it's way bigger than before. So let's have a look at this. After the Shanghai fork, demand for staking outpaced the demand for exits, which is good. So the proposal may take on added significance ahead of potential Ethereum ETFs. So Ethereum ETFs are probably coming. Bitcoin is the number one. So you had Bitcoin futures ETFs, and then you had Ethereum futures ETFs. Now you're getting a Bitcoin spot ETF, probably in January, or very close to, and then Ethereum spot ETFs coming after that. So it looks like Ethereum and Bitcoin, both of them are kind of on the same course. And so now it's just up to which one is going to be more desirable over time, right? If they're both big and available, then which one is actually going to outperform and be the desired asset over, you know, the next 10 to 20 years. This may attract an institutional audience who may have an interest in staking their ETH to earn passive income. Institutions are attracted much more to reliability rather than these crazy price gains, right? If you're an institution or you're a pension fund or something, you're not looking to invest in these tiny little things and make, you know, these massive returns. That's what your venture thing is for, right? So you have a tiny percentage of your portfolio, which is like venture capital, and you don't even look at what you're investing in, right? You just kind of give it out to fund managers and say, yeah, whatever. And, you know, we'll look at your percentage gains at the end of the year. Big institutional capital, though, for Bitcoin flowing in, potentially flowing in now, is like, this is what we're going to have. Again, they actually think this is like the risky side. They will allocate a very small amount to it. So Bitcoin and ETH potentially being institutional grade is going to change the makeup for them. It's going to change them as networks a lot. And so again, percentage gains may drop over time, but you know, more reliable. So realized transactions per second for ETH and rollups. A lot of people are saying ETH is dead, or, you know, they're moving on to other chains. Remember, these are retail degen traders who need low fees. Ethereum is not developing for that anymore. Ethereum transaction per second stays the same. And then you've got rollups. Rollups is where a lot of the retail users and a lot of the kind of growth is going to come. As you can see, it's going insane. So Ethereum base layer is not meant for retail. It's expensive. It's slow for a reason, because it's secure. And the rollups is where a lot of the, you know, kind of experimentation is going to happen here. But again, this really does benefit ETH as an asset, in my opinion. Now, network activity. What are people using a network for? This has changed over the bear market. So you have, of course, Uniswap, which is always going to be big. So it's like the number one app on Ethereum. Trading of tokens is obviously going to be the number one thing. What else? You have Telegram bots, which have really blown up in this bear market. So something that you can use, just an easier interface to trade with. So you can, you know, trade with those bots. You also have Rollups becoming a huge buyer of block space, which is in blue here. So again, that was very small and it's got a lot bigger. So Ethereum is scaling with those Rollups. Retail users are only one use case for ETH, right? So you want cheap transactions to, you know, send money around or play a game or something, then that's fine, but that's only one use case. Other larger use cases is institutions trading $200 million back and forth or whatever. That's another use case, right? So those users will pay higher fees on the base layer. Retail users won't. Then you've got NFTs here, which are basically dead still. So they may come back towards the end of the bull market. But again, do people want to pay $50 fees for NFTs? No, they don't. So NFTs may kind of go towards maybe real world assets, much more expensive things there, licenses, or kind of very large high ticket items, and that's the NFT associated with them. That could proliferate, but retail investors trading NFTs back and forth, on the base layer, seems like that might not happen again, because fees are going to remain high if this isn't institutional. If institutions are in sending around massive amounts, they're going to price out the NFT market. That's going to have to move to layer 2s or other chains. But you can see, you know, things change over time. Like I said, if you want exposure to all of that, then the layer 1 coin is that exposure. Broad exposure, less volatility than you know, those specific investments. Coinbase also do a comparison here of ETH and the other layer 1s, right? What's this landscape looking like? Basically, they're asking the question, is it just ETH and L2s, or can there be a couple other networks as well that are successful? Where do developers want to build is what they're saying, right? Because where the developers are, that's where the products are going to be, and that's where the people are going to be, that's where the value is going to be. We doubt the multi-year debate between modular versus integrated will have any explicit resolution. You know, Ethereum versus Solana basically for this cycle, right? Bitcoin isn't crypto. You can see that Bitcoin, the way it was invented, created, basically can't change that much. It's not a tech platform. Bitcoin is a digital money type asset, whereas everything else is kind of more on the tech platform side. And so you have to make a decision whether you want to be super tech platform and then just be changing everything all of the time. But that makes the layer 1 coin less like money, because money has to be something that is so reliable, you know that it's going to be the same thing from when you buy it for the next 100 years, right? It's not going to change, because if it does change, then it's not money, right? And so if you go on the super tech platform side, then people are saying, well, that's great, but are you going to, like, what's going to happen in 6 months time? I don't know. So it's not money, so I can't give it that premium. So it's like a scale to be on here. I don't think there's any right answer in terms of that, but you know, Bitcoin very clearly is on the money side, right? Rollup dominance, as you can see here, this is on-chain activity gradually shifting from alt L1s to L2s. So you can see this here. This is alt L1s in light gray. You have Ethereum here, which is, you know, just the same. And then blue is rollups. So the rollups are growing massively and they're eating into the market share of alt L1s. Now, what I will say here is that alt L1s in this are Polygon, Avalanche, BNB Chain, Phantom. Okay, so BNB Chain and Phantom's not really doing anything. BNB Chain, you know, got crushed from regulation. But there's no Solana and there's no Tron, which are two like the most successful chains at the moment. So, you know, there's still an area. Look, there's still a huge market for alt L1s, as you can see. So yeah, Ethereum and L2s are eating a huge amount into those, and they have to, because the Ethereum L1 is obviously just for institutions. You can't scale it. So Ethereum is scaling massively. It's eating a lot of market share. If this continues, then Ethereum is going to be majorly dominant. But it may come up to a certain percentage, still growing. And a lot of the smaller chains may just kind of fall to the wayside. And you may have maybe 1 or 2 competitors to ETH only that are big. But that's how every industry goes anyway, with, you know, 1 major or 3 major players and the rest kind of not. While the transfer activity measured by transaction counts seems gradual, which is this, the transfer of liquidity paints a much more aggressive shift. So as you can see here, other bridges, which are noted as all of these down here. So this is Arbitrum, Optimism, Base, ZK Sync, Starknet, Immutable, Linear, Mantle, Polygon, ZK, Rainbow, Wormhole, Stargate, all of these. So what you're seeing is other bridges are getting crushed and the layer 2s are going higher. So where are people bridging assets? Where are they taking assets from? They're taking it from ETH, they're bridging it over to the layer 2 direct, rather than some of the other chains. So, you know, this is a successful implementation of rollups, in my opinion. What you're seeing is Ethereum becoming institutional settlement. The assets are going up onto the layer 2, which is reducing fees. And so those reduced fees allow institutions like Bybit and OKX and Binance and Coinbase to build their L2s on ETH, and their customers are retail, and so they're giving lower transaction fees to retail investors. So the roadmap is kind of working right here. This uptick in L2 activity has not resulted in a significant increase in Ethereum transaction fees due to the cost-saving nature of rollups. To put this into perspective, the transaction fees paid to the Arbitrum sequencer over 2023 was similar to that spent on MetaMask through Arbitrum, though Arbitrum had 100 times the number of transactions. Why this is important for me is because what we're seeing here is scale increase, transaction fees down. And why that's important is because you can extrapolate that to say, essentially, given a long enough time horizon, the transaction costs to do something in crypto are going to get crushed down to sending data, right? Because there is competition that will crush transaction fees down very, very low. And so remember, these blockchains are not businesses. They're not YouTube. They're not Google. Google makes money by taking a commodity, which is sending data around, and then it builds a high margin business on top, which is advertising. So you're sending data on YouTube, right? So I send the data in, they hold it, and then you call it out. You send an email or you search for results online, the data's there, you call the data, that's free. It's so cheap that it's free. The way they make money is the high margin business of advertising that they build on top. A blockchain can't do that. A blockchain cannot do that. A blockchain is simply sending data around. And so fees are going to get crushed over time. Therefore, what is valuable in crypto is a large, decentralized, trustworthy, non-government money type asset. Bitcoin, potentially Ethereum, and if the others want that, you need to prove that you're large and decentralized and you're that type of thing. Solana's approach to protocol development tends towards enshrining features and complexities at the protocol level, as exemplified by the native SPL token standard and massive hardware scalability. So here, what has Solana done? Solana just said, we need fees to be cheap and we need the blockchain to be fast because our customers are retail investors, right? If Ethereum, the base layer, is institutional, you can't build another one of those. So Solana says, we can't build that. We can't compete with that. We need to be fast and cheap for retail. So Solana is competing more with like layer 2s, in my opinion, right? So what they've done, Solana, is just made the blockchain really bloated and large. So I think the Solana blockchain is around 200 terabytes. It may be like 100 to 200. I can't get a definitive figure here. Let's say call it 100 to 200 terabytes in size. Whereas the entire Ethereum blockchain is around 1.4 terabytes if you're looking at the whole thing, although not every node has to download that. For Bitcoin, it's 500 gigabytes. Which one is more decentralized or has the ability to, right? So with Bitcoin, it's just money, very, very light blockchain. People run it at home. With Solana, it's just not. So which one has the best chance of being a large decentralized money? You know, it's not Solana. So Solana is way more on the tech side. You can see Ethereum's kind of in the middle, and then Bitcoin's the other side. So you have like each end of the spectrum, right? Left, middle, and right side in these three assets. Maybe you want to own all of them. Maybe you think all of them have value, or you know, just one of them or none of them. Solana has claimed an increasing amount of developer mindshare in 2023 with its differentiated fundamental design philosophy. Because remember, Bitcoin is money and not a tech platform. And Ethereum, when it was invented, wanted to take Bitcoin and make it a little bit more expressive. And then Solana's just like, no way, man. We're on the other side. We're scale. So yeah, developers love that. But as an investment, is that going to be the same as a large scale money like BTC? What's going to have more value? I believe it's BTC over the long term, but over the short term, you know, things outperform BTC all the time. Notably, only 8 chains of the 235 analyzed have a TVL of more than 500 million. These are the chains depicted in chart 27. In aggregate, 8 chains constitute approximately 90% of all TVL in crypto, and most of those are Ethereum or EVM based. So Ethereum, Tron, BNB chain, Arbitrum, which is Ethereum anyway. That's it. So it's actually really, you're looking at the industry, there aren't that many investment opportunities actually, in my opinion, right? You have Bitcoin, which isn't crypto. Within the crypto space, you have Ethereum, which is very large. And then you have a lot of other kind of tech plays, which are trying to be much more expressive or much more specific in the audience they're going for, but they're much smaller and they're not, you know, challenging Ethereum with its scale, which is potentially, you know, trying to be a huge worldwide asset. So it's actually a small industry. I don't think there's too many investment opportunities in the layer one space, right? They are what they are. Trying to go out on the risk curve is just going into smaller assets. You can see right here that what has outperformed is Solana, despite a lot of stuff happening on ETH layer twos. I think this is a couple of things. The first one is retail investors maybe don't get the narrative of layer twos, right? It's much more institutional. Like, try and explain what Arbitrum is or what optimism is. They're like, I don't know what that is. But with Solana, it's just like Solana is Solana. That's the thing. Here's your wallet. Use this chain and that's it. Also, it's a massive airdrop season right now on Solana. So they timed it very well. As the market inflected back into, bullishness, they just did loads of airdrops and they, got a lot of PR and a lot of attention. So that drives prices higher. Whether that can be sustained, that's obviously, we're going to look at that over the next few years. I cut out about half of this report. If you want to read the whole thing, I'll link it below. Updates coming to the crypto course in January. If you've got the course already, they're coming free for you. So just wait for those updates to come. I'm James, it's MazzyG. Cheers for watching, and I'll see you in the next one.